Hey, Dan Passarelli here. How are you today? First of all, I want to make sure you can hear me. If you can hear me, please go to the questions box and just give me a big old yes. Let me know you can hear me. Inquiring minds want to know. Thank you, Justin. Much appreciated, my friend. Excellent, excellent. Okay, thank you, Vano. Today we are going to talk about what I call the MTM trading plan or the MTM trading path. MTM, of course, being market taker mentoring. That's where I hail from. I'll tell you more about that in a minute. But the trading plan is your path to success. Now, before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. And you can get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here in this presentation today is generalized information and not personalized to your specific situation. So for those of you who don't know me, I see some familiar names here today, but for those of you who are not familiar with me, once again, my name is Dan Passarelli, and I am an author of two popular trading books, been part of a couple other books and projects, hundreds of articles, working on my third book, actually, as we speak. And I am a trader. I started out my trading career down on the floor of the Chicago Board Options Exchange, also traded on the Chicago Board of Trade, and now I trade in a retail account just like you. And I am the founder of Markets Taker Mentoring, which is the global leader in option trader education. Also, I collaborate with a lot of good people in the option trading industry, many quality options friendly brokers like Firstrade, as well as many of the options exchanges, software organizations, etc., etc. And let's see here. Oh, yeah. Well, I'm a family man, married to my wife, Kathleen, and my two adult children. And I do other things for fun besides just trading. I'm a runner, foodie, traveler, and a music person. Now, I always like to give you something special when you show up to these. And so today I'm going to give you this. We're going to have another online training this afternoon at 4:30 Eastern time, which is 3:30 Central or 1:30 Pacific time. And you can attend it by simply going to markettaker.com/REG. Market like stock market, taker like take what is rightfully yours, two T's in a row. Markettaker.com/REG. That's short for register, and you can get yourself registered. And what we're going to be talking about today is sort of like the mental part of trading, which is really, really exciting. Okay, so the MTM Trading Plan, your path to success. So this is basically a checklist. And the story kind of goes like this. So when long ago, I used to trade, kind of long ago. I used to trade on the floor of the Chicago Board Options Exchange. And then in 2005, the exchange approached me and asked me to teach classes on their behalf. And long story short, I did that, and they flew me around the world teaching both retail traders and professionals how to trade options. And like one of my first days on the job, somebody said, "Hey, Dan, what are the steps that you take when you make a trade?" And I just thought that was such a silly question. Like, what do you mean? I just find a good trade and I trade it. What are you talking about? Because when I was down on the trading floor, the way it worked is, somebody would say, "Hey, what's the market here?" And we'd give a market with the hand signals and shouting in the brightly colored jackets and stuff, like 80 bid at 85. And he'd say, buy him an 85. We'd say sold. And then we'd go back to our crossword puzzle. You know, it all happened in a split second. And it's easy to lose sight of like all the things that would go through your mind in a split second. And I did have that checklist inside of me, but I just traded for so many years that it was so second nature that I didn't even realize it. And so when another person said, Dan, what steps do you take? And then another, I realized, you know, maybe I should try and pull it out of my brain here. Talk about like what what are the steps? And that helped me a great deal. And it continues to help me to this day because having a series of steps, a checklist, ensures that methodology is being followed. Processes ensure successes. That is a quote by this guy, Edwards Deming, who is an American engineer, statistician, professor, author, lecturer, and management consultant. And he's got a lot of good quotes. One of my favorite things when I'm putting together webinars and PowerPoint slides like this is getting to look up quotes by people because the ones that stick and end up on the internet usually tell a great story in just a sentence or so. And this is one I love. If you can't describe what you're doing as a process, you don't know what you're doing. Think about that. That is so, Edward Deming was not a trader to the best of my knowledge. He had all these other things on his resume. But man, isn't that just so telling for traders? Isn't that just so like that is what like that could have been written just for traders. And how about this one? It's not enough to do your best. You must know what to do and then do your best. Right? So many times, I mean, look, I'll tell you the truth. Even in my career, earlier on, I would see something that seemed like a good trade and I would make it and didn't always work out before I really put together a process. How about this? It's not necessary to change. Survival is not mandatory. Don't you love these things? I just love it. I just love it. All right. Well, let's keep all those things in mind here. And let's think about what it's like before using a process to make your trades. Who's ever felt like this guy before? Go, hit that questions box. Give me a me, if you've ever felt like this guy before. You're just ready to pull out that hair in clumps. Like, oh my gosh, how could this have happened? Right? Come on, don't be shy. Anybody who says that's never happened to you, you're just totally lying, right? It's happened to all of us. Well, this is what it feels like before using a process. And after getting that process down, putting your trading plan together, yeah, feels like this, right? So let's talk about a couple of things here. This is what I call the MTM Trading Plan Checklist. We've got our technical setup, identifying volatility events, volatility analysis, state our forecast, select our strategy, do our Greeks and risk analysis, come up with our exits and adjustment plan. Then we execute the strategy, our plan, our execution strategy, execute the trade, and then adjust and exit. There's actually one missing from here, and that's the last one, what we can call a post-mortem. Just learning from every trade. But I'm going to make a big statement here. Do you think that it could be possible to increase your current trading results by 20%? Hit that questions box And tell me, what do you think? Do you think it'd be possible to increase your trading results by 20%? Yes or no? Now you have to answer. There's two choices. It's a binary event. Shane says yes. Justin says yes. Anonymous says yes. Michael says yes. Well, that's good. That's why you're here after all, isn't it? To improve. Now, increasing your trading by 20%, I mean, that sounds like, pretty impressive. Michael says yes, right? But I'll tell you what, I mean, it might be even more possible than it seems. Now, let's just explore this a little bit here, okay? What if you could learn just a little bit more of your technical analysis, right? One additional little trick to whatever else you're doing that gives you a little bit of an edge, and your trading can improve by potentially 5% as a result of that. An extra 5%. That'd be pretty good, wouldn't it? Yeah, sure it would, right? Okay. Well, what if I've done it with your recent trades just by research and organizing? Oh, that's awesome, Shane. Great job, man. Great job. I love hearing stuff like that. And here you are looking to do even better. That's great. What if, I mean, this one might not be for everybody, but for some people, right? What if you could, like, some people don't always look to see when earnings are or when the next Fed announcement is. Like, these are things that can cause like big volatile moves, right? You put on a credit spread and all of a sudden, the stock's up 5% in a day. And you go, oh, geez, blew through all my strikes. I'm at maximum loss. Oh, no. I mean, if you just did that one extra step by going to the Google machine and typing in stock symbol investor relations, right? Like, AMZN investor relations. Oh, there's earnings are on blah, blah, blah date. Maybe I shouldn't put on this iron condor or time spread, right? Like that could save you. Geez, I mean that could make a huge difference in your trading if you don't do that already. How about volatility analysis? We're going to talk about that. What if you could get better at identifying overpriced or underpriced options and choose your strategies accordingly? Hmm? Could you do 5% better on that? What about a better forecast based on those three things? How about selecting more optimal strategies? Hey, I think this is going to be a channeling stock or a sideways trade. Should I do an iron condor or a butterfly or a time spread or a double calendar? Which one? Well, so those first three steps can help you with that. Getting better with the Greeks and risk analysis, uh, tightening up your plan, your execution strategy to middle markets better, doing a good job with executing the trade. All these things, if you could just get a teeny bit better in each of these steps, I mean, geez, how many do I have listed here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, in theory, I mean, you could do 50% better if you just got better, a little bit better with each of these steps. I mean, pick four of them, right? That would get you up to 20%. I mean, this is a hypothetical conversation, obviously, but I think there's a strong point to it. So we're going to talk pretty generally today, but this is the key takeaway. Technical setups. What if we could get better with identifying a trend? Because, like there's basically three different trends you could identify, right? A breakout going through a specific spot, resistance or something. Momentum, just picking up momentum, a strong RSI or something. Sideways trade, channeling, or no trend present. We need to know that these are the three or the four things we can identify. And we need to use certain tools for that, certain drawings and indicators. Like when you are here, hold on a second. Let's look at you guys hear my dog snoring in the background? Just like the whole house is shaking, and she only weighs like 5.5 pounds. She's a Yorkie. You know, like we come down here and we can use support and resistance lines, right? Hey, there's resistance or whatever. Um, get rid of that one. Put little notes on our charts. There's a lot of different things that we can use, whether it's any of these indicators, right? We can go to moving averages, throw it on there. And everybody kind of has a different thing, right? Today's class is not necessarily about telling you what my best tools are, but they're to open your mind to help you come up with a plan and use the and work in appropriate tools. In fact, here, wait, let me back up for a second here. So notice that this is a very general checklist, right? And why is it general? Because the first couple of times I got asked about this, like one of the reasons why this was hard for me to wrap my head around is because, hey, if I'm trading a straddle, well, I've got a certain set of criteria. If I'm trading a covered call, I've got a whole different set of criteria. If I'm trading a time spread, I got a whole different set of criteria. So I thought, well, you can't just have this one checklist, but you can. So what the goal is to take all these steps and for each type of options strategy you trade, personalize each of these, not personalize, but customize each of these to that strategy. If it's a technical setup, I want to see a volatile stock. I would love to see a volatility event. I would like to do a volatility analysis and see high historical volatility and low implied volatility. If I'm trading a covered call, I would like to see resistance up top. I would like to see no volatility events. I would like to see overpriced volatility implied above historical and in the top half of the 6-month range. We'll talk more about that. So I challenge you after this session, go and get set up a Google Sheet or a Word document or a piece of paper and a pen in a notebook and type out or write out your trading strategy for each of the types of option strategies you typically do. This will help you limit your universe from, I don't know, I could trade anything that looks good, and have it be so general that there's not a tight enough checklist, to I'm going to focus and get great at these things: credit spreads and time spreads. Maybe that's it. Maybe credit spreads, time spreads, and covered calls and cash secured puts. And for each one of those, you're going to take this and you're going to say, okay, for credit spreads, what technical setup do I need? What do I need to look at for fundamental analysis or volatility events? Do I want earnings to be coming or not? And you're going to set this up for each one of those. If you do that, I believe that your trading can greatly improve in a short period of time, especially like the exits and adjustment plan. So, okay, technical analysis is really a map of human behavior. You ever think about it that way? Like here, let's get this Amazon chart back over here, huh? So we're looking at this, right? Amazon chart. Oh, look, it's kind of selling off the last, we're kind of hit here. Is this earnings? I forget if this is earnings or not. And then we've been in like a little bit of a mini downtrend. The moving average is a little lower here as well, right? Okay. Why is that? Why are we in a downtrend? There's really only one answer. I mean, you can come up with 1,000 answers, but there's really only one answer. Why is Amazon in this little mini downtrend? Who can tell me? Why is Amazon in this little mini downtrend? Who can tell me? Come on, let's see who's first. It starts with the word more. There we go. Thank you, Justin. More selling than buying, more sellers than buyers. Well, really more selling than buying, right? It could all be one person theoretically. So this is just a map of that human actions being taken. Anytime the stock goes up, it's because there's buying pressure, there's demand. Remember in economics class when they talked about the law of supply and demand? This is what they were talking about. When there's demand and more people are buying, they buy the shares that are offered, and then they buy the next offer, higher offer, the next higher offer, next higher offer, next higher offer. Anytime it goes lower, somebody's selling the highest bid and that bid's gone. Now they sell the next highest bid and that bid's gone. Now they sell the next one. Now they sell the next one and forces the price down. This is just simply a map of human behavior. That's really important to recognize. It's not magic. There's no magic formula. There's no set of indicators that are going to, be a crystal ball and always be right. All these indicators just help you see this map more clearly. It is a potentially a head start, a way to acquire edge on your trades, right? Does that make sense? So some of my best technical analysis tools, and again, this depends exactly on what the specific option strategy you're using are, but I use a lot of support and resistance, trend lines, higher highs and higher lows, and vice versa. Patterns, double and triple bottoms are very strong, flag patterns and triangles. Indicators, I'm a big RSI and slow stochastic person. I use moving averages a lot, including and especially crossovers, gaps, different candlestick patterns. Identifying volatility events. I mean, this can be a little bit broader than this. This is kind of our fundamental analysis. Now, fundamental analysis can sound very intimidating, like, oh my gosh, I have to know how to read financial statements, right? That's a skill that a lot of option traders don't have. If you do have that skill, you've got a great advantage there, and you can put that to use. Who is that just said earlier? It's been doing more research and such, right? I assume that that's fundamentally based. But bare minimum, we want to know when earnings are. We want to know when Fed announcements are, when the monthly unemployment reports coming out, other major anticipated news releases, because those are the days where we can have the biggest moves. And there's some option strategies we want big moves, and some that big moves can hurt us. So we want to plan around these events and look to the left, as they say. If we're looking at a chart, when they had their last earnings, what happened? Was it a big gap? There's some companies, like especially, younger companies, especially in the technology space, younger companies who when they have earnings, they can gap 20%, plenty of them. Then there are some that are big conglomerate companies that have been around for a long, long time that barely move when their earnings are announced. We want to know. So we do our due diligence. And like I said, my best tip for you on that one is just type in the stock symbol, type in investor relations, and see what comes up. And always have resources planned out. We want to have a calendar of economic events. Do you have a calendar of economic events? We post it in our newsletter every day. In fact, if you register for our webinar today, you'll be put on our list and you'll get our newsletter every Sunday night. And it'll tell you what major economic events are coming out this coming week. Very useful information. We want to consider all micro events too. Is there some sort of board meeting? Is there a product launch? Is there earnings? Weigh whether the macro events are necessary to even consider. Some companies have a beta of greater than 1. That means if the S&P 500 goes up 1%, that stock should go up more than 1%. That's kind of a measure of volatility in some ways. Some that have betas less than 1, the macro events might not be as big a deal. And then we want to use volatility charts to establish if volatility is overpriced or underpriced. Now, this is something that a lot of people look at as a more advanced options analysis technique, but I'm here to tell you it's not really advanced. I've been teaching options since the exchange asked me in 2005. So it was my 20-year anniversary of teaching option trading to option traders. And long, long ago, I came to realize that there is not beginner, intermediate, and advanced lessons. There is the stuff you need to know to make money at trading or not. That's it. I could say this is a beginner class and hold some of it back. Or I could say this is an advanced class, you beginners stay out, but then you'll be missing out on the important stuff, right? So using volatility charts are very, very beneficial. And there are tools out there and many of them are free. You can just Google volatility charts and find a free service that offers them. Because it's essential to use them because it helps us determine whether volatility is overpriced or underpriced. It is a crucial step to guide the strategy selection. Hey, if I'm bullish, should I buy calls and be getting positive vega, buying implied volatility? Or should I do a bull call spread where I'm hedging off some of that volatility? Or should I sell a bull put spread where I'm actually short volatility because it's overpriced and I think it'll come down? I want to get, even though I might have a directional trade, I want to use all these other things also to get extra edge. Like, look, if you and me are going to run a race, right? The 50-yard dash or whatever. Okay, well, the person who runs fastest is going to win. Okay, but that's a little bit of an overstatement because what if I got a 5-meter head start? Well, all of a sudden, my chances of winning just improved. I mean, we're still running to the finish line, right? The goal is still to run faster than the other person, but I have this extra thing that helps me. That is what volatility analysis does for you. That is the key market taker mentoring teaching. This is arguably the edge. I mean, all these are edge, but this is a huge source for edge. There's something that I call the 1, 2, 3 volatility analysis. If you're taking notes, take this down. Find a source to view volatility charts. And we're going to look at 3 different things. Number 1 is on the volatility chart is today's implied volatility in the top half or bottom half of the 6-month range. If it's in the top half, that's one sign implied volatility may be overpriced. If implied volatility is in the bottom half of the 6-month range, that's one sign that implied volatility might be underpriced. Step 2. Is today's implied volatility above or below today's historical volatility? Now, there's a little bit of nuance with this, okay? So, I mean, I've got a whole 5-hour class on it broken up into 4 parts. I mean, there's a little bit of nuance, but, just big picture. If today's implied is above today's historical, that's a different indication that maybe implied volatility is overpriced. If today's implied is below today's historical, that's an indication that maybe volatility is underpriced and it's better to buy options. And then three, we want to forecast out what the probability is for both implied and historical volatility rising or falling. I use this on every single option trade that I make, every single one. And it benefits me by giving me an extra edge. Just, it's still the 50-meter dash, but I get a 5-meter head start. It makes it easier to make money. If I lose by less. If I win by more. So you got to keep it in perspective. I use it on every trade. It's very important, but it's not necessarily the most important thing, but it is an important thing. You want to win the 50-meter dash, you got to run fast. But if you got a couple steps head start, it's going to help. We always use a 6-month chart because the market was different 6 months ago. I could say that any day of the year, any decade, the market was always different 6 months ago. Earnings are unique. We tend to like to avoid them or time spread them under certain circumstances. Don't time spread all of them, obviously, but there are certain time spread setups that benefit around earnings. Can you explain that last point again? Yeah, Aslam. Hey, how you doing, Aslam? So, yeah, that last point to forecast out what implied and historical volatility might be in the future. I mean, part of that is when is earnings? If I'm going to sell a 1-month iron condor, but earnings is in 2 weeks, well, I'm going to have on this iron condor through earnings. If usually it gaps 5 to 15%, that's not good. I will forecast that historical volatility is likely to gap up on earnings, right? Or if we're getting into a time of the year where like implied volatility has been climbing because there's a lot of worries about, whatever, you can fit in your reason du jour, like, oh, well, the deadline on tariffs are supposed to be on blah, blah, blah date. Implied volatility might be wanting to rise if that deadline is approaching. Or, this one government is, like I remember 10 years ago or something, like Greece was in bad financial state. They thought they might default on their debt or something like that. Implied volatility up, 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 up. So we want to kind of forecast what those trends are likely to be, because if we do an option selling strategy and implied volatility goes up, that's going to work against us. If we do an option buying strategy and implied volatility is climbing, that's going to actually benefit us. Make sense? All right. So let's see here. You are welcome, my friend. You are welcome. And, like I said, there is a lot of nuance with it. We want to avoid false signals. There's something that I call, like in my book, Trading Option Greeks, I call it a volatility mesa, which is when historical volatility gaps up because there's a big gap in the stock chart, and then because it's a 30-day volatility or whatever it is you're calculating, it stays high for 30 days. And then after 30 days, this gap drops out. It becomes the 31st day and it's no longer in that calculation. So then just as fast as it went up, stayed high, it comes right back down. It looks kind of like a mesa in Arizona or whatever. Yeah, Aslan, Google volatility charts. And I don't know if you're on my email list for when I do trainings and such, but I talk about it all the time in our classes. So, once you find volatility charts, if you attend one of my other free trainings that I do, I'll talk about it. In fact, I'll probably talk about it. I know I have talked about it here with Firstrade. And if not, remind me next week, because next week I think they're going to be asking me for the next 6 weeks of titles or whatever. And I'll try and sneak one in on volatility charts or something. Okay. All these things that we talked about so far, they're all for the purpose of stating a concise forecast. This is a key step. Do you know how many stocks have options listed on them? I forget. I think it's like it's like 5,000, give or take 500. All right. But then there's calls and puts. And there's minimum of 4 expirations, a maximum of like 20 some expirations. And then there's all these different strikes. And then there's all these different spreads that you can create. There's a gazillion, that is a precise figure. There is a gazillion different option trades that you can put on. In fact, even if you're just looking at one stock, right? You're looking at one stock and you think the stock's going to go up. There's still scores of ways you can trade that. I could buy this call, or I could buy this call, or I could buy this call, or I could buy this call on a different expiration, or this other call on this other expiration, or this other call. There might be 100 different calls listed. I could buy any of them. I want a big delta or a small delta. Long-term to expiration with a low theta, or short-term to expiration with a high gamma. Or spreads. There's when I do those first 3 analysis steps, that's going to guide which specific option strategy I choose. There's a best one for any given situation. All right. So that helps focus our intent to set up the optimal option strategy where I make the most, lose the least, and increase my chances of winning. Maybe we can get good enough to squeeze out an extra 5% on getting good at stating the forecast. Maybe more, who knows? This is most often underused step. Focused intent makes trades better. So here's what we have to do. Take a screenshot of this or write this down. I'll be on the slide for a minute, so maybe you can just write it or type it or whatever. If you're going to state your forecast, we want to have a time horizon. Now look, if you're looking at a chart and the short-term moving average crossed above the longer-term moving average, and RSI is rising or whatever, ADX is rising, and it's bullish. Over what period of time? Now you might say, I don't know. And you're right, you don't know. But this step actually happens in your brain without you knowing it. It does. Kind of weird to say, but it's true. Start with the extremes. Okay, if I'm bullish on this stock, do I expect it to rise in the next 5 minutes or the next 5 years? Okay, both of those are a little silly. How about the next hour or the next year? Maybe still a little silly. The next 3 days or the next 3 months? Okay. Now I could probably answer that. No, this is like a swing trade, right? So time horizon, up, down, sideways, or volatile. Those are the 4 directions that we can have in a forecast. And the degree of the move. Now you might say, I don't know how much it would go up if it goes up. And you're exactly right. But if the stock is at 50, is your target $50.20 or is it $100 over the next 5 days? Well, 20 cents, I mean, that's nothing, right? Doubling over the next 5 days seems kind of ridiculous. Let's bring that together. How far does this typically move in 5 days? That's one thing I love to do. I do this all the time, and it's so ridiculously simple. Nothing fancy. If I know that I'm going to keep okay, so we're basically bouncing off support on this Amazon trade, right? Or not, well, not bouncing yet. We're basically sitting on support right now. Let's say I want to play that support level between now and the end of the week. And it's Tuesday. I always do my trainings here for Firstrade on Tuesdays. Okay, well, rest of Tuesday, Wednesday, Thursday, Friday. Okay, in 4 days, what's a reasonable bounce higher? 240? I mean, it's possible. Of course, it's possible, right? That's about the width of this candle, but this is like the biggest candle on the whole chart. Well, over the last 4 days, it's moved, about four or $5. Well, that's probably pretty reasonable. Are these candles about the usual size? Yeah, maybe. Here's some little teeny dojis that happen over here. That's a lot of uncertainty. We've had some bigger ones. This is kind of about average. Yeah, I mean, over the next 5 days, about $5 is a pretty reasonable range to expect. Okay, well, what happens to implied volatility? I've been talking a lot about implied volatility because, it's pretty underrated. It's more important than most people think. Implied volatility is basically how cheap or expensive the options are. If Amazon goes up $5, what happens to its implied volatility? Well, it probably comes down a little bit. That means even though you have a positive delta position, you're making money on delta, you might lose a little bit of money on implied volatility on Vega. Optionally, kind of, our confidence interval, but this kind of happens in your mind as well, too. Do I know Amazon's going to go up $5 over the next 4 days? No, I don't know that at all. I can't see the future. But if I always follow the exact same steps and always use the exact same criteria on these sorts of trades, I always wait for it to bounce off support and I wait for a confirmation candle or I wait for it to go through the blah, blah, blah day moving average. And I make notes. I'm right 65% of the time, hypothetically. Okay. Now I've got an idea as to what's reasonable. Okay. I don't know I'm going to be right, but I feel pretty good about this trade. That can guide your position size too. So basically, like this statement right here, if you are screenshotting anything, screenshot this last bullet point. I expect stock symbol over the next number days to rise, fall, go sideways, be volatile by whatever percent or dollar amount, and implied volatility to rise or fall by how many points. You fill that statement in for every trade, I believe you could trade better starting today. You will select better strategies because the stated forecast guides the strategy selection. Mastery is part of transformation from beginner to consistent success. So here, I think it's possible to squeeze out 5% on a trade by just selecting better strategies. Two comparable strategies will have somewhat different P&Ls, true or false. That's true. A debit call spread or a credit put spread with different strikes and maybe different expirations, they'll both make money if the stock goes up, but one will make more, one will make less. How do I know which one? I don't know which one. But if I'm looking for a massive move higher, well, selling a put credit spread is silly. I miss out on tons of upside. I'd rather just buy a call. If I'm looking for just a small move upward or barely a move upward, a put credit spread's way better. If I'm looking for a move upward to a certain point, a call debit spread is better. This is a skill that you should work on developing. Let strategy selection be a natural extension of your stated forecast. Consider among three alternatives and select the optimal based on the forecast. How do I know which one is optimal? Well, you don't know for sure, but if you like look at like just draw like a profit and loss diagram, say, oh, well, this one I make this much if what I think is going to happen. This one I only make this much. I'm going to pick this one. Greeks and risk analysis, exits and adjustment plan. I'm kind of throwing a lot in here. The Greeks of strategy guide trade entry, trade management, adjustments, and exits. Knowing the Greeks is essential. That is why my first book was Trading Option Greeks, because there wasn't another book written on the Greeks at that time. How could there not be a book written on the Greeks? It's the single most important thing for option traders. Look at my maximum gain and maximum loss. That gives my best and worst case scenarios. That's very important to controlling your risk. Project expected return and possible loss. Plan for both winners and losers, right? All of your trades are not going to be winners. They're not. All of my trades are not going to be winners. No way. So I have a plan for winners and losers. I was just explaining this concept to somebody who has never traded before, has no interest in trading, but we're on the subject. Like you're like the hardest thing in trading is the exit. And the only way to do it is to have a plan for it. Do I want to accept assignment or not? For adjustments, give possible market permutations. Do an automation for trade monitoring and exit orders. I'm going to set an alert or something if I can do that. Execution strategy. Is it going to be a limit or a market order? Good till cancel order, day order? Market on close. I do those about once a week. I use a strategy with that. Do I middle the market or not? Do I leg in or not? So like that can be really important, although it's trickier than it appears. Einstein said everything should be made as simple as possible, but not simpler. Don't overthink it, but think it through as much as you need to. Use proper order types, right? I will use market orders sometimes. I will use limit orders more often. I will use market on close orders. Good till 90 days orders. You need to fine tune entry with the 5-minute chart sometimes. Spreads can be really good for middling. I call this the 25-20 middling technique. So, oops, hold on a second here. Come on. Let's go up to options and look at option chain. Like, do I want a middle? On Amazon, I don't have to middle. It's penny wide, penny wide, penny wide, penny wide, penny wide. These aren't a nickel wide because if it's over $3, it trades in nickels, not pennies. It's about as tight as it gets. If I look at a different stock, like maybe US Steel, oh, well, these aren't a penny wide. This is 9 cents wide. This is 19 cents wide. This is 8 cents wide, 15 cents wide. So, if I'm always buying the offer and selling the bid, there's a lot of slippage. I'm leaving a lot on the table with each and every trade. So I'll do what's called middling the market. Now, middling the market doesn't mean trading exactly in the middle. 19 bid at 29. I'm not going to try and do these at 24 cents. If I'm buying, I pretty much have to buy a little closer to the offer. If I'm selling, I pretty much have to sell a little closer to the bid. So what I'll do a lot is what I call the 25-20 middling strategy, where I'll say, okay, so this is 10 cents wide. What's 25% of 10 cents? Well, 2.5 cents. And if I'm buying, I'll go, 2 or 3 cents below the ask. If I'm selling, I'll go 2 or 3 cents above the bid. That's 25% away. And I'll count to 20. If I don't get filled, I'll go closer to the bid or the offer. Because I don't want to sit and wait for, an hour and have the stock move totally away from me and never get filled. So that's a really great little technique for you. It's a very hands-on approach, to tell you the truth. You're basically following a plan, but the enemy seldom agrees with your plan. So the more skill you have in exiting, the better. So final thing, checklists, they add to your bottom line because they make sure that you are on track, that you are following a plan, that you are sticking with your plan, and you can track results and know that your plan works. All right. Any final questions before we call it a day here? Any final questions before we call it a day? It was a good class, wasn't it? Yeah. You guys always ask good questions. I love it. All right. Well, then that said, folks, have a great rest of your day. Oh, wait. Can we get it? I don't give out PDFs, Aslam, but Firstrade puts these recordings on their YouTube channel. If there's like one presentation that you like is really valuable to you, just go to their YouTube channel and take screenshot it. I've done that before. I'll just put them all in one folder and I'll name them slide 1, slide 2, slide 3. Michael, you're welcome, my friend. All right. Have a great rest of your day and trade smart.